We're going to wait another minute or so for a few more people to catch up with us. It's about 1:33, so we'll give it another minute or so as people click on to the webinar website, the link. That's not a minute, but we'll get going anyway. Hi, everybody. Uh, Welcome and thanks for joining us today to talk about the economy, the Fed chair nominee, bank capital, and you. I'm Dennis Kelleher. I'm the co-founder, president, and CEO of Better Markets. For those of you who don't know it, we just celebrated our 15th anniversary, so we're particularly glad to welcome you to this webinar. There's lots going on in Fedland, from economic developments like inflation, the proposed rules deregulating Wall Street's biggest banks, and the hearing on Trump's nominee to be chair last Tuesday, all the way to the FOMC interest rate decision next week on Tuesday and Wednesday, followed by Chair Powell's what's supposed to be his last press conference on Wednesday, and 2 weeks later, what's supposed to be his last day as Fed chair, but we will see. We won't be able to get to all of that, but we'll hit some of the highlights. I'm going to kick it off with an overview, and then I'll introduce two of our terrific team members, Chris Apple and Philip BASIL, to go through the details. And then we'll have a discussion and get to your questions. Please submit questions throughout the webinar through the Q&A at the bottom of your screen. We'll get through as many as we can, but if we don't get through them all, we'll answer them afterwards and post them to our website. And speaking of the website, these are complicated issues, and we could talk about them for hours, but we're only going to talk for about an hour today. But don't worry, because we have tons of materials on our websites on these subjects and the related subjects, www.bettermarkets.org. We'll also be posting a video of today's webinar along with the slides shortly after the webinar, as well as some additional materials, not just today, but in the coming weeks and months. Another way to keep up with what's going on at Better Markets related to capital and otherwise is to sign up for our newsletter and our Substack, which you can also do on the website. Okay, now let me run quickly through some of the key points at a high level before turning it over to Chris and Philip. And to do that, I'm going to share my screen. And I apologize in advance for being somewhat pedantic. Um, so first, why should anybody care about bank capital? Well, bank capital is key to a well-functioning economy and a safe and sound banking and financial system. The amount of equity capital banks in the banking system have directly impacts whether a bank fails or not, whether one bank's failure causes more banks to fail, whether those failures cause banks to pull back on lending to save money to cover their losses. Now, that, of course, reduces the amount of lending to households and businesses, which then slows the economy, causing recessions and, yes, even depressions. And the amount of bank capital the banks or banking system has also impacts whether those bank failures lead to a financial collapse or crisis, and whether the government and taxpayers end up bailing out those banks to stop a crisis. Now, that's what happened in the 2008 financial crisis that caused the Great Recession. People forget, but you have to remember that that crisis cost Main Street Americans more than $20 trillion in untold suffering. Unemployment reached 17%, or 27 million Americans were out of work 13 months after the failure of Lehman. There were 16 million foreclosure filings in the United States. And of course, there were lost savings, educations, retirements for millions more, and frankly, the loss of the American dream. It was so bad that according to a Fed study in 2018 that showed at the end of 2016, 8 years after the crash, 90% of the American people were poorer than they were in 2007 by 17 to 35%. That's the cost of the crisis. It happened again at a much smaller scale in 2023. That banking crisis had direct costs of about $40 billion and indirect cost all in about $300 billion. So simply put, what stands between a failing bank and taxpayer bailouts and an economic calamity is the amount of equity capital a bank has. Now, it's important to understand that the issue of equity capital is one of timing and who pays, not whether adequate equity capital is needed. As to timing, the issue is, will a bank be required to have enough equity capital before it fails so that it can absorb its own losses and doesn't fail in the first place? Or will that capital be supplied after its losses exceed its equity to prevent its failure? And as to who pays, it's either the bank has enough of its own equity capital to prevent failure in the first place, or the government uses taxpayer money to provide the capital after a bank's losses exceed its equity. And of course, that's what happened in 2008 and again in 2023. The easiest example is Silicon Valley Bank. It went bust in 2023 because its liabilities exceeded its equity capital by about $20 billion. So it failed, but was rescued and bailed out by the federal government that supplied the $20 billion. So because they made the choice not to have enough adequate equity capital ahead of time, that equity capital was supplied by you, the American taxpayer, after the fact. Now, what's wrong with the current capital rules? Well, one key flaw is that they discriminate against lending to the real economy, and they incentivize trading and other financial activities that too often don't benefit the real economy. And that's because the current rules require more equity capital for lending than for trading. Now, Basel III, which is the current capital framework, done right, was supposed to fix that key flaw by making capital requirements more risk-based. Trading and other financial activities have higher risks, so they should have higher capital requirements. So making sure capital is tied to risk is key also to making sure capital is channeled to the real productive economy and the highest socially useful activities. Now, what's wrong with the proposed capital rules? As they say, where shall I begin? Well, they are based on the false premise that the big banks are currently overcapitalized, even though all the independent evidence shows they're undercapitalized. But from that false premise, the proposed capital rules are going to slash equity capital requirements at the biggest, most dangerous Wall Street banks. And that means they're going to have a lot less capital to absorb their own losses. And therefore, when that happens, and those losses inevitably happen, they're going to need bailouts again. In fact, we project that the equity capital levels at the biggest Wall Street banks are going to be as low as they were before the 2008 crash under the proposed capital rules. Now, of course, before the 2008 crash was the lowest equity capital since before the 1929 crash that caused the Great Depression. And in 2008, of course, that's when those banks almost caused the second Great Depression. And as it was, they caused a Great Recession, required trillions of dollars in bailouts, and cost the country $20 trillion. Well, what else is wrong with the proposed capital rules? Well, adding insult to injury, equity capital at the largest Wall Street banks will be roughly equal to the level at community banks. And that's nuts. I know that's a technical financial term. The Fed uses that a lot, but that's just nuts, right? Community banks don't pose such risks to the financial system or the economy. And community banks, importantly, disproportionately support the country's communities. For example, they lend about 75 cents of every deposit dollar to the real productive economy. The biggest banks on Wall Street, they only lend about 40 cents of every deposit dollar. Additionally, and this is really important, community banks make about 40% of all small business loans in the country, even though they only have about 15% of the assets of the entire banking system. So Wall Street's gigantic high-risk bank pose serious and unique dangers to the financial system and economy that community banks simply do not, and the proposed rules are going to be seriously discriminating against and harming community banks and the lending and services that they provide to our economy and our communities. So what's going on here? Well, here's the dirty secret no one in banking wants to talk about. Banks talk about wanting to have lower capital to make loans and grow the economy. What they don't ever say is that the lower their equity capital, the higher their revenue and profits, and yes, you guessed it, the higher their compensation and bonuses. That means their compensation goes up when equity capital goes down. The banks never mention that when they're demanding lower equity capital. They just act like they're the chief economic growth officer of the United States, when in fact they're the heads of private profit maximizing banks and corporations. Now, of course, as bank equity capital goes down, the dangers to Main Street Americans go up. The risk of bank failures go up. The risks of financial crises and collapses go up. And the risk of bailouts go up. So lower equity capital, great for banks, not good for anybody else. So the amount of equity capital a bank has matters because if banks have enough capital, they don't fail, they don't cause other banks to fail, they don't stop lending or cause or deepen recessions, and even better, when typical business cycle downturns and even recessions happen, banks with adequate equity capital continue to lend, and that makes the downturns that inevitably happen less severe and shorter. And that's why getting bank capital, equity capital right can be a win-win-win. A win for the American people, for the financial system and the economy. And getting it wrong, like the proposed rules do, is only a win for Wall Street bankers and their bonuses. Now, uh, quick and high level, and I'm sorry, a little bit pedantic, um, but those are the key points. Now, let me introduce you to Philip and Chris. Chris Apple is Better Markets Director of Banking Policy. He has more than 15 years of experience shaping and implementing U.S. and international bank capital and prudential standards. He was most recently served as the lead financial institution policy analyst at the Board of Governors at the Federal Reserve System. There, he played a leading role in some of the most consequential post-financial crisis regulatory reforms, including, importantly, the Basel III capital reforms. Chris also served at the Department of the Treasury as a senior policy advisor to the Assistant Secretary for Financial Institutions. And in that role, he helped lead the Treasury's policy response to the 2023 banking crisis, which he likes to call stress. That's what happens when you're in the government. Philip BASIL is Better Markets Director of Economic Growth and Financial Stability. He has more than 20 years of experience in both the public and private financial sectors, primarily focused on capital planning, risk management, and policy related to large U.S. banks. He was most recently a financial institutions policy specialist at the Federal Reserve Board, and he was previously in the Division of Research and Statistics and the Division of Supervision and Regulation at the board. Philip also served as an executive director within the model risk section of JP Morgan Chase. Their full bios are on our website, which I'll say again, www.bettermarkets.org. And with that, I'll hand it off to Chris and rejoin afterwards for the Q&A after their presentations. And remember, the Q&A is at the bottom of the Zoom screen, so please put your questions in. Chris, take it away.
Thanks a lot, Dennis, and thanks everyone for joining this afternoon. As Dennis mentioned, my name is Chris Apple. I'm the Director of Banking Policy here at Better Markets. Our presentation today is going to touch on some of the core issues facing the banking system. We're going to start with a quick overview of the business of banking, bank capital to level set on the core concepts. And then Phil and I will spend most of the presentation talking about the 2026 bank proposals that were just released last month. And at the end, we'll touch on the process, as Dennis mentioned, the new Fed chair process and how critical that individual is to these issues and getting this right. And we are going to start at a very high level, but we encourage questions as technical as you'd like in the Q&A, and we'll be happy to answer those. So you probably know the famous movie, It's a Wonderful Life. It's probably the most famous movie about banking in America. And really, at its core, at Better Markets, we want to focus on the core business model of banking. And banking is actually pretty simple, even if the modern financial system tries to make it seem more complicated than it is. The model is basically depositors deposit money at banks, receive interest. The bank makes a loan at a higher interest rate, and the bank earns a spread. So banks really perform those three functions: holding deposits, making loans, and then also processing payments. And the vast majority of banks in the United States still follow that basic banking model. In the movie, George Bailey, who's the banker, kind of explains it very well. the money that when there's a run on the bank, he tells the depositors, don't worry, the bank's invested in other people's houses and businesses. And that's the core point. Banks provide that connective role in any productive economy. They link savers to borrowers. And when that system works well, the economy grows. And here at Better Markets, what we focus on is advocating for and promoting this type of banking model. Now, taking the concepts of that deposit and loan to the next step, what we're going to mainly focus on today is this issue of bank capital. And bank capital is simply the money that a bank shareholders invest in the bank. It is at the most fundamental level a bank's own financial cushion, or is another way to put it, the skin in the game that a bank has. One simple way to think about bank capital is that it's like a mortgage. So if you were to purchase a $300,000 house and put down a 20% down payment or $60,000, your ownership in the house starts with $60,000. So if the house drops in value, you can absorb the losses before the bank does. And banks work in exactly that same way when it comes to capital. And if you came into this presentation not knowing what bank capital is, I think that's the one thing to take away, is that bank capital is funding, and it's the investment in the bank by its own shareholders. And importantly, it's not an asset. It's a form of funding. So in effect, with a bank, taking that analogy to how banks work, losses on a bank's balance sheet or its loans are supposed to hit the shareholders first. And that protects taxpayers and depositors in the event that there are bank losses. So to put it another way, the less capital that a bank has, the more it's borrowing relative to its own money, its capital. And that means more risk. And that's where governments and regulators come in. Regulators set minimum capital requirements to make sure banks don't take on more risk than they can actually handle. So that's this debate in a nutshell. And it's really the core question that we have to answer, which is how much risk should banks be able to take, especially riskier banks, with your and other depositors' money. So banks really are different than other types of businesses. Banks have special privileges because they are chartered. And most importantly, for our day-to-day, they hold our government-protected deposits. So the negative impact of a failure of any bank, but particularly large ones, can have a very bad effect on the economy, on individuals, and on businesses. Businesses can't make payroll, layoffs rise, credit dries up, recessions become worse. And fundamentally, as Dennis mentioned, it's really an incentives problem. Banks can take on bigger risks when they have more leverage and less capital. Executives can receive larger payouts. And when that system works, the system works well for the banks. But if it doesn't work well, the public often has to pay. So it's pretty simple. Profits are private and losses are often public. Strong capital, which we advocate for here at Better Markets, is trying to reverse that type of situation because it significantly reduces the likelihood of bank failure, as I mentioned. It keeps banks lending in all types of economic environments, including downturns, and helps to stabilize the economy. The bottom line is that strong bank capital rules are the most effective and the most direct way to prevent financial crises. Now, the 2008 financial crisis, as Dennis alluded to, is really the textbook example of what happens when bank capital is too low. In the years leading up to the crisis, banks took on enormous and unsustainable risks. And this was particularly true in areas that amplify risk in derivatives and trading activities. Now, recall back to the first slide when we talked about the bank, Bedford Savings Bank, and It's a Wonderful Life. They're not talking about trading and derivatives and those type of banks. This is really concentrated in a very few number of banks. But in these firms, banks were borrowing nearly $30 for every dollar of equity. So a 30-to-1 debt to equity ratio leading up to the crisis. If you think about it another way, just 3% of losses on a bank's balance sheet would cause it to become insolvent and potentially fail. And the scale of that crisis was immense. Just to put one statistic to highlight the other ones that Dennis has already mentioned, 500 community banks failed in the 4 years after the 2008 crisis. That's roughly 1/8 of the community banks that exist today in the United States. So it is the scale of the crisis is hard to put into statistics, but it was massive. The response to the crisis was generally agreed was we needed higher capital. That was not a very disputed question, but we're still in the process, as we're going to go through in the presentation, of trying to do that still 18 years later. Significant gaps remain, and as I mentioned, those gaps are really about the riskiest activity. In 2023, the banking crisis was short but very severe, with 3 of the 4 largest bank failures in the United States, which reinforces how critical these rules are to protecting depositors and protecting taxpayers from the failure, particularly of large banks. So let's fast forward now to today. Last month, the US bank regulators, the Federal Reserve Board, the Office of the Comptroller of the Currency, and the Federal Deposit Insurance Corporation, FDIC, proposed major updates to their bank capital frameworks or rules. Now, the goal, again, we're talking 18 years later, is to finish the job from the crisis. And really, the job is about capitalizing derivatives and trading activities with stronger rules. And we're still trying to do that. Now, the stated goal of the rules is to also change the capital for credit risk and operational risk. But what has taken so much time to get to this point is a very long and arduous process to get to an international agreement about trading and derivatives activity. And importantly, for the purposes of this presentation, we're focusing on what regulators refer to as risk-based capital. Risk-based capital is how much capital banks are supposed to hold based on the riskiness of their assets. That's generally assigned by regulators, but it's also given some leeway for banks to model their own risk, which is a key point that we'll come to in future slides. Now, these proposals mainly impact the 8 most systemic banks in the United States. Those banks are called global systemically important banks, but importantly, these proposals would impact nearly every bank in the country in some form. And they are very long and very complex, nearly 1,500 pages of text. And so we're here to give you a summary and answer your questions about them, but we're going to give you the high-level takeaways so you can understand the goals better. The core question, though, that the regulators are trying to get at is, how do we update the system to make it stronger? And are we going backwards? And unfortunately, if you look at both the impact of the proposals and many of the details contained in those 1,500 pages, there's a real gap between what the rules claim to do and what we think at Better Markets they would actually do. So despite the stated goals, the regulators have stated that the proposal would actually reduce bank capital, risk-based capital, by 5% at those 8 most important banks in the United States. And this is a long-standing trend going back to 2019, where risk-based capital requirements for the 8 GSIBs have been on a downward trajectory relative to what was required in 2019. And the important fact for this is that the Fed stress test has been significantly weakened in that period. So in 2019, risk-based capital requirements were roughly 15% on average, again, taking into account the stress test at the time. And we approximate that after these proposals, if they were to be finalized in the way that they were proposed, will be roughly 10%. So it's a pretty significant reduction and inconsistent with the stated goals of the proposals. Because these rules were supposed to capitalize for riskier activities, but in fact, they will likely lead to the opposite result. And the main reason for that is that there are significant numbers of loopholes and deviations from the international minimum standards that banks have historically been able to gain. And we anticipate that that would happen again if the rules are finalized as they were proposed. The key point is that the assumptions behind these proposals, we think, significantly underestimate how aggressively banks are going to attempt to optimize and to arbitrage the loopholes. So in the most simple terms, the rules will, as stated in the proposals, lead to less capital, but even less than as is predicted, higher risk, more profits in the short term, but much higher risk for everyone else going forward. So I'm going to invite my colleague Phil BASIL to come on to explain what is actually driving these changes and what would be the second order effects.
Great. Thanks, Chris. Appreciate the overview you gave us. And Chris walked us through a bit of just kind of level setting. What exactly are banks? What are basic banks? What is capital? Why it's so important? And what exactly is in these proposals and what some of the impact might be. A couple key questions that I'm going to cover in this next section is, first of all, what really are the goals of this proposal? And second, what will the impacts be and who will be affected? So one thing Chris highlighted is just how important strong levels of capital are to the banking system and economy. So we have to ask, why is capital being reduced in the proposals? Well, the primary justification, the primary claim from the industry, as well as the banking agencies when they finalize the proposal, is that lower capital will boost lending and support the economy. Well, this is just simply not true. History and data show that higher capital can lead to more lending, and it does lead to more lending, especially in bad times and economic downturns. And so when Dennis and Chris talked about banks having a bigger cushion with capital to absorb losses, well, that means in an economic downturn, these banks can remain strong and keep lending to the economy even when things aren't good, which helps reduce the severity and length of recessions. Now, there are multiple research papers that show banks with stronger capital do more lending, but I'd like to highlight just one simple statistic here on the slide. If you look at the time window on the slide, this is actually a period when capital requirements were increasing significantly for the very largest banks, the risk-based capital requirements. And as you can see, banks' share of lending to the real economy actually increased over this period. So even just this simple statistic shows that the claim put forth by the agencies and the industry just doesn't hold water. So if increased lending isn't the goal, then what are the real goals? Well, as been highlighted by Dennis and Chris, the answer is an old one: increasing profits. And especially for the biggest banks. That is the goal. That's been the goal of their lobbying push, that they've been pushing the agencies to get exactly what they want out of these proposals. And in unpacking this, it's important to think about capital on a relative basis, because capital can make one activity more profitable than another activity. And the best way to think about that is through the risk-reward trade-off, which tells us that higher rewards or higher profits come with higher risks. But if you can make it so that you don't have to account for those risks, then those profits become even greater. And that's how the biggest banks think about capital requirements, because for a long time now, the very biggest banks have been massive financial conglomerates that engage in a lot of risky financial markets activities, such as trading and derivatives. Very far from the model of a basic bank that Chris discussed. And as you can see in the figure on the right, currently, even under the current framework, as Dennis discussed, there's already a huge advantage for financial markets activities. So here you'll see for the four largest banks, their trading activities bring in 2 times the revenue per dollar of capital than their lending activities, creating a pretty strong incentive for these banks to do a lot more trading and a lot less lending. The proposals are only going to make this dynamic even worse. We can go through more of the details in the Q&A. But as Chris highlighted, there are certain aspects of the proposal that will increase the profits on these financial markets activities. Another aspect is lending to the wealthy, large corporations and investment funds will be more profitable relative to lending to Main Street. And that's exactly the kind of lending that the largest banks do. And so it'll just make the types of lending that they already do even more profitable. So what's another impact here, or what else is going on? What are some other motivations and goals here? Well, not only can capital make one activity more profitable than another, it can make one bank more profitable and competitive than another, and can do so unfairly if capital requirements aren't set correctly. And as I just discussed, the biggest banks engage in a lot of riskier financial markets activities. And as Chris and Dennis discussed, we saw the damage that big banks can cause to the economy and taxpayers when they fail, as in the 2008 crash and 2023 bank failures. So clearly, and Dennis discussed this, Big banks have a lot more risk than community banks, which focus on lending to the real economy and don't pose a risk to the economy and taxpayers. They don't pose the so-called systemic risk that the largest banks do. But sadly, as you can see in the figure on the right, the biggest banks with trillions in assets and the most risk and the riskiest activities have capital requirements that are half the requirement that applies to many community banks. So that CBLR you see there is the community bank leverage ratio. Over 40% of community banks use that requirement. And the very largest, riskiest banks in the country have requirements that are less than half that. And for other community banks, they have requirements that are the same. This really just makes absolutely no sense. It's an upside down capital framework that incentivizes the largest banks, makes them bigger, allows them to be more profitable without having to internalize the risks of their size and activities. And it gives them an unfair competitive advantage to gain more and more market share. Well, what do we see then? What are going to be the impacts of these proposals? Well, Wall Street wins, as we've talked about multiple times in this proposal, but just to reemphasize it, big banks will have lower capital, which means higher profits, and in particular, higher profits on their financial markets activities. So they will do more financial markets activities, less lending. They'll also have lower capital and higher profits on loans to large corporations, the wealthy, and other financial institutions, which means not loans to Main Street. And in fact, just last year, large bank lending to investment funds like private equity and hedge funds increased 50%, whereas their lending to the real economy didn't increase at all. So 0% growth in lending to the real economy. And of course, bigger profits mean bigger bonuses and allows them to outcompete smaller banks. Well, what does that add up to? Main Street loses. To put simply, as I said, bigger banks will have more market share. As you can see in the figure on the right, they've already gained a tremendous amount of market share since the early 90s. That will only be exacerbated by this proposal because the profits the banks can put to work to outcompete the other banks. And what does that mean? It means fewer community banks that and that means they'll be able to provide even less of the highly critical and important support that community banks provide, especially to small businesses. As Dennis pointed out, the intro, 40% of small business lending, even though they only have 15% of the assets. And on top of it all, a higher probability of big banks failing and economic catastrophe, which, as we've seen in the past, affects Main Street the most. So I'm just going to pivot for just a minute and talk about the new Fed chair. I'm sure most of you have been following. There will be a new chair of the Fed soon, new head of the Fed. And while most people think of setting interest rates and other monetary policy actions when they think of the Fed chair, the position is hugely consequential to everything the Fed does, including regulating banks. And I'll note that the current nominee, Kevin Warsh, was a governor on the board before, during, and after the 2008 crisis. And so he should fully appreciate the importance of strong bank capital, but so far he's been supportive of the current deregulatory push. But one thing's clear, history shows we need strong leadership to put in place strong capital requirements to protect us against the next crisis. So just to summarize and bring back some of the talking points we've been touching on, strong bank capital levels are extremely important to banks, the economy, and all Americans. But these capital proposals will incentivize more risk-taking by the biggest banks, more financial markets activities, and more lending to other Wall Street firms and the wealthy. That means fewer community banks, less lending to Main Street, and on top of that, it risks causing another crisis. With that, I'll conclude and pass things back to Dennis, who will lead a moderated discussion that includes questions from the audience. Dennis, you're on mute. Sorry.
You'd think by now I would get that right, wouldn't you? I'm biased, but terrific presentation that raises lots and lots of questions. I find when I talk to people about the proposal of the Fed, the currently pending proposal on capital, that they have a hard time believing that this proposal actually is just unbelievably favorable to Wall Street banks and unfavorable to community banks, given that there are something like 4,000 community banks in the country on the street corner of many communities, small, medium, and large, from coast to coast and throughout the heartland, who know their neighbors. And the bankers, the local community bankers know their neighbors and provide support to household lending as well as small businesses. And as we all know, small business is an enormous job creator in the United States and is enormously important for wealth creation and accumulation. So when I bring these things up, people have a hard time actually believing that it could possibly be true that the Fed would propose rules so favorable to, basically the eight largest banks on Wall Street, and not more favorable to the 4,000 or so banks on Main Street. So, and you hit some of the highlights, but Philip, would you just to go over again, just first of all, is that the case? And I guess the question is, why would that be the case?
Yeah, I know it's hard to believe. It is the case, and it's shocking even to us who've been immersed in bank regulatory policy for a number of years. Why is it the case? It's clearly been an effort of the largest banks to lower their capital requirements and to do so, as I pointed out, relative to other banks, because if they're not appropriately capitalizing for their risks, it gives them an unfair competitive advantage. They can take more and more market share. They can push out banks. In fact, JP Morgan, I know, has publicly stated a target to increase their share of retail lending from retail deposits from something like 11% to 14 or 15%. Well, where is that share going to come from? They, as far as I can tell, that they're planning on it coming from community banks. And so this is it's a really tough dynamic to watch happen. And the agencies just have not woken up to the fact that there is this upside down policy framework in place. And it really just should be the case that the largest banks with the most risk have the highest requirements, and the banks with the least risk that pose the least amount of systemic risk, or frankly, community banks, no systemic risk, should have, relatively the lowest capital requirements. But that is just not the case. Well, how has this happened? As far as I can tell, it's really just the strong lobbying efforts and advocacy efforts of the largest banks using all sorts of obfuscation and honestly, in some ways, sort of holding the regulatory process hostage and saying, oh, we're going to do less lending if you raise capital. And so this, unfortunately, this is where we end up. It should be that, and I hope that the policymakers do wake up to this fact and start supporting community banks the way they should be supporting them and right sizing. They keep talking about right sizing the capital framework, but true right sizing is setting it straight and increasing capital for the largest banks relative to community banks. And just to close out, I mean, as you pointed out in some of your talking points, but just three key points on community banks. I mean, their relationship lending model is so important. So not only, as you pointed out, do they do more lending on a percentage basis of their deposits? 75% of their deposits direct lending to the real economy. The largest banks, only 40% direct lending to the real economy. The other thing is, through their relationship lending, community banks have much higher loan approval rates because they get to know their borrowers much better. In fact, in the latest Fed data, there's something like a 10 percentage point spread in approval rates between community banks and larger banks, which clearly shows you the efficacy of their relationship banking model. And you can see the efficacy of that model in the fact that they have lower loan loss rates. Their underwriting processes through their relationship banking model works way better. And so because of that, not only do they have higher capital levels, they also have lower loss rates, which allows them to lend more and lean in more during recessions and truly support their community. So it really is time we do start supporting community banks, stop paying lip service, and right-size the capital framework in the way it should be right-sized.
Thanks. And Chris, what do the agencies say that the proposals would do to the capital requirements for the biggest banks? And I know based on your presentation, we don't agree with that assessment. What factors are they not considering? And in particular, you referred to how the banks not just game the loopholes, but also optimize capital. And I think the banking agencies appear to be overly confident that the biggest banks will not be overly optimizing or overly gaming the system. But what exactly are they saying that the proposals would do to the capital requirements for the biggest banks? Because, of course, they're not admitting what we're saying the facts show.
So, as I mentioned, Dennis, this is a set of three proposals, and two of them impact the largest eight banks, and those are the banks that the Fed and the other regulators believe are systemically important. There's an interaction effect. There's this process called the BASIL framework, and then there's a separate process called the GSIB surcharge, which is a special capital requirement for the largest banks. The BASIL framework would increase capital, but very slightly for the largest banks. But then this separate requirement called the GSIB surcharge would decrease it significantly. So the aggregate effect of those two rule changes, along with a stress test change, which would reduce, according to the agency's impact analysis, capital requirements by 5% for those eight banks. And as you were pointing out, Dennis, in your question, this is a static analysis. This does not take into account history and all of the examples that we have of banks that have very sophisticated operations to be able to set up their balance sheet and set up different types of structures. And these are very complicated structures that require a significant amount of supervision to reduce the actual requirement without changing their actual risk. And this is something that banks are very focused on. And the reason they can do this is because these are changes to what I was referring to in the presentation as risk-based capital. And risk-based capital has been around for about a little over 35 years. And it has some benefits, but it has a lot of costs. And one of those costs is that it's extremely challenging to supervise, and it's extremely challenging to understand the models that go into how banks report their data. And one final point to understand is that the major goal of this process that we're referring to, and this has been a 16-year process, was to constrain the ability of firms to model their risk. But unfortunately, the proposal actually does the 180, and it allows firms to model the risk, but never have their non-modeled approach reduce their capital or increase their capital. So it really is a 180 of what we anticipated, and I think goes against the objective of what the purpose of the entire process was.
Thanks. Again, another audience question. They want to get a clarification. Philip, I'll give this to you. Can you explain a bit more what specifically the financial markets activities at the GSIBs are that get favorable capital treatment here? Is it securities dealing, underwriting, something else? Where's the favorable treatment go, which is, I think, related to your, frankly, terrific and striking chart on the income per dollar of capital. Maybe you could spell that out a little more.
That probably one of the most impactful, and Chris, you can also weigh in on this, but probably one of the most impactful changes and deviations from, as Chris talks about, what was agreed to internationally, is this concept of, might be a little, complicated in the weeds, but what they call cross-product netting in the derivative space. And so essentially what the proposal is allowing is to net one risk against another. In this case, specifically, it's derivatives in repo and repurchase agreement transactions. So just to get a little more specific, but that will be hugely consequential. Derivatives can lead to a lot of what risk-weighted asset, a lot of capital requirement. But in allowing this, it will allow banks essentially to artificially shrink the amount of risk that's present in those derivative transactions. So that's on the financial markets activity side, that would be one of the more impactful changes that's being made. I don't know if Chris,
Okay,
if you have
let me
anything to
just
add to
interrupt
this
for a
one.
second. When you say artificially shrink, I assume what you really mean is what they're going to be doing is understating their risks in the trading book.
Correct, because essentially, well, first of all, you're netting two products that essentially have nothing to do with each other. So that's first and foremost. Second, there's all sorts of gaming that can go on. Banks already do this. It's what's called compression, RWA compression, derivatives compression. You can look up the term. You can look up in fact, the Office of the Comptroller of the Currency puts out data on this, at least for the deposit, for the banks themselves, not necessarily for the broker dealers. But it does show just how much through, honestly, a lot of times just changing the nature of legal agreements, they're allowed to reduce their capital. I mean, I don't think a lot of people realize the kind of things that banks do to reduce their capital requirements, and even something as that you wouldn't even think. So, for example, as I'm saying, changing a legal agreement with a counterparty, and then it's all of a sudden interpreted in a different way according to the capital rules, which then leads to a lower capital requirement. So, and this proposal allows for even more of that type of gaming and RWA compression and capital reduction, in other words.
Yeah, Dennis, if
Okay,
I
no,
could just jump in, that
sure.
Phil mentioned one type of product, but the general gist of why this will be more favorable to the firms is that the agencies did not propose the minimum standards that apply in the Basel framework. And the other key point for the audience is that supervision is critical to overseeing market risk because it requires expert examiners to be able to push back when firms make choices that are inconsistent with the capital rules. So without supervisors that are given the ability to have that authority, it's very challenging when firms take these stances that are inconsistent with the goals of the actual text, but also they're going to be able to model significant amounts of exposures into what we call the trading book, as Phil mentioned, to reduce RWA. Inconsistent, I think, with the initial objective of this process.
Okay, hopefully that clarifies it. But as I'll say it again, there'll be a lot more detail on our website if that doesn't. Somebody asked, don't higher capital requirements generally push industry toward consolidation since compliance and capital costs scale more favorably at larger banks? How do you reconcile advocating for higher capital requirements with wanting to preserve a diverse and less consolidated banking system?
Um, well, in that regard, I'll just, Chris, you can jump in after, but I'll just point to the Federal Reserve Bank of Kansas City maintains a quarterly banking profile. Or sorry, not quarterly, it's a quarterly bank capital analysis, rather, where they show the capital levels at banks of different sizes. And it pretty clearly shows that community banks maintain capital levels that are basically double the capital levels of the very largest banks. So, and that's the way community banks have always operated. It's the way they continue to operate. So it isn't the case. Community banks don't have a problem with raising capital. Community banks get most of their capital through their retained earnings. In other words, they take and reinvest their earnings back into their funding stack. That is just part of their business model. And so community banks really are not struggling to have capital, raise capital. It's really at the larger bank level where capital allocation and capital competitiveness becomes a lot sharper. And I think that's part of the issue is there's so much focus on the largest banks and the dynamics of the largest banks that nobody really thinks about what's going on at the community bank level. And the numbers clearly show that community banks, as far as their capital is concerned, they're doing just fine. And so that dynamic really does not play out at the community bank level.
If I could just one more point on that's a great question. And I think cuts to the heart of why leverage capital is an ideal way to capitalize for smaller banks because it's very inexpensive to comply with. The risk-based capital rules require, to the questioner's point, extensive amount of compliance costs, which can price out smaller banks and put an unnecessary amount of administrative burden on them to comply. So having simple leverage rules would actually make it a lot easier for smaller banks to compete when it comes to standardized capital requirements than very complex rules.
Good point, Chris, which is why the community bank leverage ratio does exist. And
And
as I
and
point out, a lot of community banks do use it.
it's why 50% of the community banks opt in, right?
Right.
Exactly.
Particularly those on the smaller end of the scale.
Yeah.
Right. I'll ask a question about a movie first, an audience question about a movie, and then a technical subject. Um, the first one about the movie says, in the background of It's a Wonderful Life, Peter Bailey led the building and loan from 1903 to 1928. And contrary to what my children think, I wasn't alive then. But and then the questioner goes on to say, eliminating Glass-Steagall in 2000, somebody predicted a catastrophe in a decade. Several people did. In fact, my boss, Byron Dorgan, Senator Byron Dorgan at the time, predicted it would happen within 10 years. Um, the question is, are we all living in the era of Peter Bailey again, which is to say, essentially the Roaring Twenties?
Uh, it's a good question, and I would say we are. It's what it seems like we're living in the era of the run up to the financial crisis. That's more what it feels like the era that we're living in again. You just have highly leveraged, very large. We keep calling them banks, but as I pointed out, they're really just financial conglomerates that happen to own a bank. They engage in a lot of derivatives, trading activities, investment banking, wealth management. And they're doing more and more of that. In fact, there's an article, I think it was in the Financial Times, that showed the record revenues that banks had, the largest banks had last year, really was driven entirely by their trading, derivatives, investment banking, wealth management. I mean, that's where they're making their money, and that's where they will continue to be making their money. And as I pointed out, this is all being complicated even more so by the connections with the non-bank financial sector. I mean, lending to private equity funds and hedge funds increased, I can't stress this enough, increased 50% last year. Whereas among the biggest banks, whereas lending to the real economy didn't grow at all, 0%. We're in an era where these banks are just highly leveraged. They have minimum capital. Capital's going down even further. They're engaging in more financial markets activities, and they're juicing the leverage of other financial players in the financial system, increasing their risk, which eventually will spill back on the banking sector. So, yeah, a
Right.
bit of roaring 20s, but feels a little more like the run up to the financial crisis.
And to be clear, when you say the biggest banks increased their lending and activities with non-bank financial institutions like private equity, private credit, um, what, 50% last year and increased lending to the real economy, not at all. That's a choice the banks make, right? And this presumably gets back to optimizing their capital, which is they're allocating their capital, their working capital, to where they're getting the greatest returns. And right now, they're getting the greatest returns in their trading and activities with non-banks rather than in the loan portfolio. Now, isn't that in part due to the discriminatory capital requirements we currently have, where loans actually require more capital than the higher risk trading activities?
Yeah, and Chris, you can also talk a bit more about this, but that's correct, Dennis. There are already baked into the capital framework, there are incentives to make, particularly to non-bank credit intermediaries, in particular, receive a favorable capital requirement. And so when people talk about sort of pushing out lending from the largest banks because of higher capital requirements, I mean, you really should be looking at it in the flip in that banks are using their lending capacity to support non-bank credit intermediaries because that gets a much more favorable capital treatment in the framework.
Right. It's also interesting because that means the top line reporting by the bank saying we're increasing our lending really tells you nothing. So whenever I see these things about
Right.
our lending's going up, the real question is who are you lending to and
Correct.
what is the money being used for? The
Right.
answer, if you're a community bank, is pretty clear when you've got 75 cents of every dollar of deposit going to the productive economy in your neighborhood versus at the biggest banks, what you really have is all that so-called lending going to non-bank financial companies because obviously it's the best interest of the country to be increasing their lending to private equity, private credit, and hedge funds, right? I mean,
Right.
okay, let me go to get to another couple of questions. We're almost out of time. This one's a little bit more complicated. It may require written answer on the website, but let me ask it anyway, which is how does Better Markets view the gap between the U.S. proposal and the EU UK Basel III implementations, particularly the US rejection of the output floor for market risk when Europe is phasing in the full 72.5% floor. Now, I avoided mentioning the output floor, but it's a good question and an important question. So if you could answer it in a way that people could understand, that would be great.
I'll do my best on this one. It's a very good question. Um, the the goal of this entire process has been to minimize the ability of banks to use their own estimates to set capital requirements. That has what's been driving this whole process. So to the questioner's point, other countries that are implementing this minimum standard have applied this concept where we can constrain the ability of banks to set their own capital requirements in effect with with a more conservative baseline. And yes, the United States proposal does not include that concept. And it's something that was noted in some of the remarks around this proposal. And it's something that we are very concerned about because that is exactly what we want to avoid, is the ability of firms to have unlimited ability in effect to reduce their capital based on their own estimates. And we've to the points that Phil was making prior, like this is exactly what happened in the pre-2008 era when banks were given much more leeway to set their own capital. And I think admittedly, most people understood that that was a mistake in hindsight.
Yeah, and of course, we're back not only to the pre-2008 crash era of low capital, we also have essentially gutting supervision and regulation. The Fed, under the new vice chair, for some reason thought picking an arbitrary number of 30% and cutting the supervision and regulation division personnel by 30%, while enacting supervision and other rules that are broadly deregulatory, not just at the Fed, but at all the banking agencies. And you put that all together, and you're really just lighting a fuse, the end of which really is only one outcome, which is unfortunately a crisis and a crash of some degree. We're almost out of time. In fact, we might be technically directly out of time, but let me quickly ask and answer a question, which was one of the first ones, which is consumer credit card debt is at an all-time high. Is that another reason to keep bank equity at even higher levels? And of course, the answer is yes, because when there's an economic downturn, even a regular business cyclical downturn, never mind a bank-driven deregulation, low capital crisis type thing, you end up with greater losses because people are out of work. More people out of work means they're not paying their mortgages, they're not paying their loans, and that means the loan losses at the banks are going up, and that means they need their equity to cover those losses. If they don't have equity capital to cover those losses, then they're going to be insolvent, and that means they're either going to fail or the government's going to bail them out. So the greatest stress in the financial and the consumer sector, whether it's consumer credit cards or auto debt, home debt, or whatever, increases the risk to the overall system when there's a downturn. One other comment that was made that I'll just touch on, which is, nobody's spoken about AI, and I have to say it's probably a record-breaking event to go almost 60 minutes and not mention AI. But we studiously avoided that because we could spend a lot of time talking about AI, and Better Markets is engaging on the AI issues kind of across the board. We have not with us on screen today, but we have a new director of AI innovation and economic opportunity who maybe not coincidentally also came from the Fed staff, joined us a couple of months ago. The question is there any risk from the AI industry, which is highly leveraged to these large banks who financed AI? There's a big debate about the degree of lending from big banks and medium banks to the AI companies and what the implications are. And that's still to be seen. But of course, there's also the much bigger or maybe the same size problem of the implications of AI, both for its potential positive uses and nefarious uses. And I think we see it with Mythos and the gathering of the head of the banks to deal with what is potentially a catastrophic algorithm which evades all of their systems. I mean, really, what could go wrong, right? AI is going to be the challenge of our time. We'll be devoting significant time, attention, and materials to that in the coming weeks, months, and years. You can look for that elsewhere, but we thought we would try and stay focused on capital, which is the pending issue. Um, so with that, we've gone a little bit over. We've tried to answer many of the questions. We will answer the questions we didn't get to in writing, and we'll post them to the website. And we will also be posting additional materials. The comment period for the proposal is open until I forget when, maybe Chris or
June 18th.
June 18th. We will be commenting, and anybody else who wants to comment really should. If you care about the economy, if you care about the living standards of the American people, if you care about financial crashes, crises, and bailouts, you should. And feel free to rely on our materials. But the more people who engage in the process, the comment process, the better it is, because you can bet the big banks, their trade groups, lobbyists, and their many often purchased allies will be weighing in with propaganda that ignores the facts that we talked about today and that we will be presenting to the banking agencies in connection as they go through the process. So with that, I want to say thank you to Chris and Philip and all the people at Better Markets who made this possible. And go to our website, www.bettermarkets.org, for more information. And we look forward to seeing you in future webinars. Thanks for joining us. Bye, everybody.